to take additional questions. Joachim, up to you.
Well, hi everyone. I'm excited, like all the others, to launch this initiative. We are very curious to see whether all this will work out as planned, but for the time being, we are very happy to have you all here. And we are especially thankful for Stephan Hollander that has kindly agreed to do the inaugural speech of this seminar with a paper that is co-authored work by the authors that you can all read there. I told Stephan that I don't want to do a long, lengthy introduction because I guess that most of you already know Stephan. He's from Tilburg University, has worked extensively in the area of financial accounting. This is sort of a second project based on another paper that is of the same author team. It's also very interesting to read and has been published in QJE, I think, a good year ago or something. We are very happy to have you here, Stephan. And we are looking forward to your talk. So as Joanna already indicated, 15 minutes uninterrupted. And for everybody, I just started the taping of this wonderful presentation. So this screening will be taped. If you don't want to be on the tape, you have to shut up, otherwise you will be taped, okay? So Stephan, floor is yours, 15 minutes.
Well, thanks, Joachim. Hi, everyone. I can't see you guys, but welcome to my living room. It's to the organizers, it's a great honor to present my work. It's very early work and at this first inaugural virtual accounting research seminar. These times, for sure, for everybody, they're crazy. For one thing, in preparing for this talk, this virtual seminar, I spend most of my time optimizing my Wi-Fi router. It's an old one, and I'm just hoping that it will last until the end. So I'm a little bit nervous here. The other thing, it's all by me, myself in here in my house. I send all my family members outside, and all phones and other electronic devices have been muted or turned off. So in case you're trying to call me now and I don't pick up the phone, then at least you know why. So more serious, this is very early work. This is work in progress. This is work jointly with my co-authors. Let me introduce them to you. Tarek Hassan from Boston University, Laurens Valent, Frankfurt School of Finance and Management, and Ahmed Tahoun from LBS. This is also very much work in progress. And so I want to start with some caveats here, especially like the second one. This paper was written in just about 3 weeks at the early stages of this coronavirus outbreak. And so a lot of things have happened. And so we have been updating the measures on a continuous basis. And so for those of you who have already had a chance to take a look at our website where we publicly post our data, the data that I will talk about in this session, we've had like 2 rounds of updates already. So we're continuously harvesting newly available transcripts that become available and then updating our measures. And so now we're also at the stage of actually rewriting this first draft of the paper. And then maybe the most important caveat here is that nor me nor any of my co-authors, we're not epidemiologists. And so we're just simple economists trying to capture the exposure COVID had on firms, how they affected firms in an ultimate attempt that it will actually spur policymakers, governments out there to make data-based responses. Okay. So quickly, what we do in this paper, we develop a text-based measure along the lines of our previous work, where we introduce measures of both costs, benefits, and risks, which firms all around the globe associated with COVID-19. But also because we look at a relatively long time window here, starting from the first quarter 2002 to the first quarter, so still yesterday essentially, first quarter 2020, and we also started to extend into the second quarter 2020. How these firms are being affected by COVID, but also prior epidemic diseases, including, as I list here, SARS, 2003, the swine flu, then we had MERS, Ebola, and most recently, Zika. In this study, we use transcripts of earnings conference calls held in this period. And so we harvest only English language transcripts. And so we ended up having close to 12,000 unique firms headquartered in 84 countries around the world. And so in addition to measuring, say, the exposure, and again, in terms of cost and benefits, so they're actually like winners, some potential winners among these firms, but definitely also many losers. And risks, we also do in-depth content analysis. So we actually sit down at this stage, like human reading these transcripts to understand what are exactly the concerns. And again, also opportunities. Some firms actually experiencing opportunities, how weird this may sound like from going through this crisis. And so we conduct this in-depth content analysis. And so we can actually speak to this question, like what exactly are they concerned about? So some firms will talk about, and this is like one of the most frequently mentioned concern, collapse in demand, also disruptions in supply chains, but also financial issues. And last but not least, we also conduct an asset pricing test to see whether these newly developed measures, as we're going to label them, COVID exposure, COVID-19 exposure, to be precise, COVID-19 sentiment and COVID-19 risk, whether they are being priced by the stock market. All right. Now, I guess, so this is a paper about, say, the COVID crisis. But nowadays, and I guess this has been said like for centuries already, it's all about uncertainty. This is just a quote from Randy Frederick, Vice President of Trading and Derivatives of Schwab Center for Financial Research. This is a quote from a Wall Street Journal article. And in this article, this is about trade treaties. And so, I mean, it goes without saying that involves like lots of uncertainty in terms of like things are happening. But there are other corporate headaches, if you like, including politics. And so as Joachim already indicated in the introduction, that this is what we study in another paper, you know, uncertainty, which, you know, rises around elections or like sudden government shutdowns. And so this is something that we have studied. More recently, the UK's decision to leave the European Union, the Brexit, climate change, another very important, like a quote unquote headache, a worry, a concern to many corporate managers out there, invoking huge amounts of uncertainties. And so in this paper, we add to this list by looking at how epidemic diseases, and in particular COVID-19, induced uncertainty for listed firms around the globe. And here's just some headlines from recent newspaper articles, again indicating that it's mostly, you know, uncertainty, fear of coronavirus rather than the virus itself hits economies. Wall Street Journal in February. The next quote showing that rampant volatility takes hold of U.S. stock markets. The Washington Post, a few weeks later, March 18th. The next quote from Johnson & Johnson CFO, who warns that the coronavirus, so the COVID uncertainty can actually affect the precision of guidance. So it's mainly uncertainty that's at stake. But in this paper, we acknowledge that, but also we want to extend in saying it's not just uncertainty that's driving everything that we see in the paper, but it's also next to uncertainty, essentially like the second moment, the variance, if you like. We also try to capture the first moment effects. So COVID-induced first moment effects. And this is more, let's say, you know, how expectations are being updated about the means of firms' futures. And so in this paper, we introduce measures which try to capture both dimensions, the first and the second moment of the COVID shock. So how does this paper fit into existing literature? You know, there's quite, you know, it's getting very crowded, and in terms of, you know, papers coming out on COVID. And so if you look at, say, the macroeconomic literature, there's a large literature which has studied in a relatively short period of time the effects that the COVID outbreak, but also like government responses to this in an attempt to mitigate. And generally, these papers shows that there's going to be huge impacts in terms of supply, demand, and also financing. We, however, we look at this from a microeconomic perspective. So we study how COVID exposure affects firms. And here we expect that this shock may actually affect firms in different firms in different ways. And also same firms, but then over time in terms of varying exposure, in terms of magnitude, significance, but also in terms of, let's say, the concerns. You know, some firms might actually be winners, quote unquote, and others losers. Some recent work shows, that's the third bullet point, that some of these existing models that have been used and tested and developed around, let's say, prior shocks of any nature, and some policy remedies might not uphold for the corona crisis. Meaning that any prior epidemic experience really calls for, you know, careful calibration against the unique features of the challenge that we're facing today, with lockdowns, travel restrictions, like emergency reliefs offered by governments, and so on and so forth. And so ultimately the goal of the paper is, again, as I said, we introduce a firm level measure, which is also time varying. We use quarterly earnings conference calls to measure these firm level measures. In an attempt to gain a better and a more deeper understanding of the various ways in which firms all around the globe are being affected by epidemics, including COVID, but also prior epidemic diseases. And again, in an attempt to hope that government and other policymakers are to start developing effective and data-driven policy measures. So one thing in terms of resilience, that's the title, subtitle of this slide. One thing that we document in this paper is that firms that have previously experienced an epidemic disease, H1N1, for example, the swine flu or SARS, these firms tend to have a relatively less negative. Let me put this up front. Overall, what we document, so whenever there's discussion of COVID, up until now, it's predominantly negative. So the overall tone, sentiment is negative. But we find that for these firms, which have previously experienced an epidemic disease, their tone, the sentiment is significantly less negative. And so their expectations about how the disease will affect the future cash flows tend to be more positive than firms without such experience. And that's, I think, an interesting finding that we document. Also, as I mentioned already, we do conduct some asset pricing tests. These more optimistic expectations are also reflected in asset pricing, where we use both short-term and long-term window stock returns. All right, so a brief note about the context. Most of you, I guess, are familiar with earnings conference calls, so I'm going to do this relatively quickly. We think it's a natural and timely context to capture the thing that we want to capture here in this paper, the COVID outbreak and their exposure. One of the main reasons is that the discussions, but also, I guess you could also argue the presentation part of the conference call is mainly driven by uncertainty faced by market participants. So it's either prompting managers, knowing that investors are facing these uncertainties, to kind of spoon feed them with this information, or it's driving conference call participants to ask questions and for managers to give them public signals during the live Q&A in the conference call. So we obtained these conference call transcripts from Refinitive's ICON database. And as already mentioned, for now, we only focus on the English language transcripts for this time period, first quarter 2002, up until and including, and this should be second quarter because the second quarter recently started. So we also started harvesting second quarter 2020 conference calls, 11,943 unique firms and headquartered in 84 countries. So this is our main source of data. We also obtained financial statement data, Compustat North America, US firms, and for non-US firms from Compustat Global. Stock returns we obtained from two sources, CRISP, again for US firms, and Refinitiv data stream for non-US firms. And to locate firms, we decided to focus on the operational headquarters, and we obtained that data for sample from Refinitiv data stream. Okay, so as I said, we introduced various measures. Yep.
Maybe Stephan, let me step in now, because we are, people are interested in your work and they are starting to ask questions. So I think we're going to start with, so first of all, a lot of people say, okay, hey, and thank you, and nice, and so on. And then let's start with Marty Guesch for first question. So I'm not sure, Mark, will you unmute Marty so that he can talk? Marty, can you talk?
I know Marty can talk. He's a colleague of mine.
Yeah, sure. So
mute now.
Yeah,
So
now you can talk. Marty, go ahead.
Hey, Marty.
Hi, Stephan. Can you hear me? Can you?
I can hear you. Yeah, perfectly.
Okay, good. So I have a couple of questions, but let me start from probably the first one. Is there anything that we can learn from this new uncertainty environment of this COVID that we didn't know from other kind of uncertain periods, let's say Brexit or climate changes type of disclosures, etc., etc. You were having this initial slide on uncertainty. Excuse me. So can we take anything new from the COVID, or is it something that we more or less can have from previous work? And here we're doing the kind of empirical exercise from this very important thing that is happening right now in the world. Right.
Yeah, thanks for your question. That's a very good question. I mean, we also get this question from other people. So the other paper that we have, and so essentially the technology that we developed is in the paper that Joachim mentioned, the political paper, the 2019 paper, and so that's the technology that we initially developed to capture political uncertainty, political risks that firms face. Now, I mean, one thing that is, I guess, and that's clear, at least to most of us, and I know there's some debate about this, so, I mean, Donald Trump and others are arguing that maybe this is not unintentional, and maybe there's maybe like Chinese government might be behind this. But I guess the big difference here is that this may most probably, and that's kind of my take, this does not originate from politics. And so we're looking at uncertainty here, which has, government is looking as, from the side, and trying to intervene and taking all kinds of measures in terms of to mitigate the impact. But I guess we're like, I would say this does not originate from any like politician or of the sort. So that's the one big difference. However, the other thing that I want to say is that in terms of the spread, this is it's health related, and so the prior papers that we worked on is like politics, and so in the Brexit paper, for example, that's also clearly politics. So and so maybe so this in this paper, politics is more, let's say, looking at things from the sideline and trying to intervene and trying to mitigate the impact by coming up with all kinds of policy measures. So, I mean, that to me would be like the main difference here. However, say at a more higher level, of course, COVID uncertainty is uncertainty, and so political uncertainty is also uncertainty. I guess the main difference is this is harder to grasp and harder to maintain, harder to isolate, harder to kind of deal with in terms of, it's spreading. We're trying to take all kinds of measures. Countries varies in terms of the measures that they take. Some decide to have a full lockdown. Other countries decide not to. So, I mean, there are all these attempts to kind of mitigate the impact, and some are more successful than others. And so I think so if you ask me, I think that's one of the main differences of the type of nature of uncertainty that we're looking at these days, relative, let's say, to uncertainty that arises around elections, political elections, and Brexit, for example.
Stefan, so thank you for this answer. You have to imagine now that you're facing a large room with participants eager to ask questions, and you have like 10 hands up. So word of advice, make the answers snappy if you want to continue to present your paper.
If I have a short answer, the thing is that
this is what I wanted to say.
This is a very difficult question, and so I don't have a short answer. I'll do my best.
It's also a smart question. So next question would be by Tengfei Cheng. So here we go, Tengfei.
Hi, can you hear me?
I can hear you.
Yeah, so my question is about the difference between uncertainty and risk. And I know that you use the term risk in your paper, but when you interpret the COVID-19, you say it's uncertainty. So I'm just wondering how do you distinguish the two terms, and how do you interpret them?
Yeah, so Joachim instructed me to give a short answer and short reply. The short reply is that in the paper we can't. And so the way that we measure, so the thing that we call COVID risk is actually, so in a conference call, we're going to look for every time there's a mention of COVID as a word. And if within, say, 10 words around it, so plus 10 words, minus 10 words, a risk or uncertainty synonym is being used. So it could be risk, it could be uncertainty. In that case, it's going to be flagged, and we're going to label this as COVID risk. So at this stage, we are not in a position to tease out any differences between risk effects or uncertainty effects. We just label this collectively as COVID risk.
We have another question by Jihahi Lu. So sorry for mispronouncing all the names. I apologize.
Okay, so can you hear me?
Yes, we can.
Okay, so my question is that since you try to investigate the firm's exposure in the context of the COVID-19 and H1N1 and SARS, so what are the difference among these viruses? And since we know that the H1N1 happened in the US and SARS had not expanded to many countries and mainly happened in the Asia, so how do you deal with the asymmetry issue, asymmetric influence of these virus? And thank you. Yeah.
Yeah. So I mean, so your question is spot on. This is, I mean, so these are not. We're not looking at a homogeneous group of diseases, if you like. And so the spread is different, the rate of spread is different, countries affected is different. And so let me actually postpone answering this question. We actually have a slide, some graphical evidence on this. So bear with me for a few more minutes and hope to get to this point to actually show you some graphical evidence.
Okay, thank you.
Okay, then we have a next question by Milda Tuleit.
Yes, thank you, Jochen. Can you hear me?
Yeah.
Mm-hmm.
Yeah. All right. So I was, well, many questions there, of course, but one was whether it really relates to the prior question, but in a more general sense. So how is the general preparedness of the firm to deal with unforeseen risks related to the sentiment that they express right now in terms of COVID? And well, on the other hand, is this sentiment more related to the risk management in the stock markets, or is it more an economic characteristic of, well, has an economic nature for the firm itself?
Yeah. So, I mean, a very good question again. I mean, these are all good questions. So, here, I'm going to show, and I hope to should be able to show you actually an excerpt from a transcript. So, where management, and this is out of the top of my head, is an airline industry which has experienced H1N1, so the swine flu in the past. And so when, in this conference call, in a recent conference call talking about, and there's discussion over COVID and how COVID will likely affect this firm, management is saying, you know, we gain experience from having gone through the swine flu epidemic crisis. We gained some experience, and so we expect that we are better prepared. Now, Whether this is actually helping managers or hurting management, that in itself is something that we don't know. I mean, they might actually overestimate being prepared, whereas in matter of fact, they're not. I mean, we talked about uncertainty. I guess you just cannot rely on any prior experience to know for 100% sure that you're well prepared. But this is exactly what management says. So, for example, firms in quite a large number of conference call transcripts, we've seen instances where management says, you know, we've experienced a prior epidemic disease, and we decided to diversify supply chain shocks. Meaning in the past, we used to be relying on just one supplier, and to kind of diversify, avoid running into similar situations again in the nearby future. If we ever get hit by an epidemic disease again of a similar order, we try to diversify these types of risks. And so they tend to rely on having like multiple supply chains these days. So this is real economics, I think. I think that's the best way to answer your question.
And then we have another question by a name I can finally pronounce. That will be Thorsten Sellhorn.
Hi, everybody. Thanks for running this, and thanks, Stephan, for presenting. My question relates to another recent paper that I read about the COVID-19 epidemic, and that's not really a paper, it's more of a paper-led 4 pages by Lauren McDonald, who document that pandemic risks have been rarely mentioned by most firms in their 2018 risk reports and in the MD&As.
Correct.
Now, to me, it seems that what you're measuring is, to some degree at least, a measure of, let's say, a voluntary disclosure about pandemic exposure.
Correct.
Of course, primarily in the presentation part of the calls, to a lesser degree in the Q&A part. Can you and do you calibrate your measure to the extent that firms did or did not anticipate the pandemic risks in their prior risk reporting, for example?
So your question is, whether we can verify whether first there was like a risk factor, a COVID-related risk factor mentioned in the 8K, and subsequently there was the conference call? Is that kind of what you have in mind?
So basically the question is, if companies have been talking a lot about pandemic risk before the crisis hit, then the uncertainty about their exposure would be much lower than it otherwise would be, and then we would expect less of a discussion about that in the conference call that you're looking at.
Yeah, so one thing that I can say for certain is that actually at some point in time, the SEC urged managers to be more forthcoming. And so that kind of speaks to itself. I think that firms were reluctant somehow to disclose COVID-related risks in their risk paragraph and as SEC filings. And so the SEC kind of urged management at that stage to actually to be more forthcoming. So I guess I think it's just as you said. We're looking at a voluntary disclosure here, and my sense is that most firms. So the conference call discussions on COVID would be actually precede the formal discussions most of the time, and the relatively few cases that we see disclosed in 8Ks.
Thank you.
You're welcome. Thank you.
So we have 4 questions to go, and then I think we give you a little bit space to continue your presentation, if that's okay with everybody. So the next would be Fabrizio Di Meo.
Hello, everybody. Thank you for these seminars. And yeah, I was just asking because in your empirical setting, you are considering the conference calls of 84 countries. So you talked a bit about this while you were replying to previous questions. However, I was just wondering, how was it possible, because all these 84 countries are likely to have adopted different public policies, right, against this COVID-19.
Yeah.
So was it possible to consider, and the different public policies were likely to affect firm sentiment towards this crisis. So were you able to assess in a way these public policies that are likely to affect firm sentiment?
Right. Excellent question. And so my first response here is that, so in all the analysis that we do, we include country fixed effects. So, I mean, that's kind of throwing out the baby with the bathwater, I guess. So you're actually saying there's something in here that some variation that you could exploit. At this stage, we don't. And I guess the main reason is, so normally you would actually like expect questions like this, and these are very good suggestions, and you would actually like implement them in the first draft of the paper. I guess, as I said, we just like, it took us like 3 weeks, and so we decided not to sit on the paper any longer, to put the data out there so other people can use it, and policymakers could, you know, base their measures on it if they wanted to. And so we now have a long list of things that we want to consider next. I mean, the thing that we look at, so in terms of validating our measure in terms of infection rate, for example, I mean, if you look at, so we can actually do the analysis at a country by country level if we want to, and over time. And so we can actually see the correlation and study a correlation between country specific measures, policies, measures taken, and say infection rates, potentially mortality rates, and how that coincides and correlates with the change in exposures country by country and over time that we document. So there's a lot of things that we can subsequently do. At this time, we just didn't have the time to actually sit down and do it. But these are excellent suggestions.
Thank you, great.
Okay, then we have a question from Elvia Shoki. Shoki, I guess.
Hi, I have a very quick questions. Out of those 84 countries, you know that development of capital market is different. I mean, they do have different regulations, they do have different policies, they do have different types of reporting and things like that. How do you control these 84 countries if the level of capital market is different? Thank you.
Yeah, good question. Short answer is we don't. Again, so we include country fixed effects in our analyses and trying to absorb that that variation. At this stage, we don't touch that, but that's a good suggestion.
Rushanda Moldovan is next. Rushanda.
Hi everyone. So I'm just wondering if it would make sense to look at more than just the earnings conference calls, because there are other types of transcripts that FactSet has, for example, that are from more timely events such as brokerage conferences or sale updates. So you might have more of a timely assessment of risk there. Thank you.
Yeah, I mean, good suggestion. I mean, I made it sound like this is a very timely measure. Of course, it isn't. I mean, let me put it slightly different. I mean, so conference calls are only held, and earnings conference calls are only held like every quarter. So maybe, you know, as a coincidence and fortunate, quote unquote, so the outbreak kind of happened during the first earnings season, and so that kind of enables us to you know, to measure and track developments over time in a timely fashion. But then, of course, if you happen to have your first conference call held in the first week of January, then we had to wait for another like quarter to have like an next observation for the same firm. So in that sense, it's not timely at all. I guess these other venues that you suggest could be interesting to look at. We haven't at this stage. At the same time, if you have like investor conferences, and this is not a firm-specific conference, but maybe let's say industry conferences, of course, then the next question is, does it provide sufficient level of granularity? I mean, can we really relate it to specific firms? At this stage, the short answer is we only looked at these earnings conference calls, and so yeah.
So last but not least, Charles Cho has also a point to raise.
Yes, hi everyone. Thank you for the seminar. This is a bit out scope of my area, but I'm quite curious and interested. And I think part of it was already addressed in the first couple of questions, but exposure seems to be largely a function of uncertainty and how big that uncertainty is. And so if that's the case compared to the other crisis that we had, besides the size of the you know, crisis now, what's so special about COVID? I mean, how do you measure also that kind of magnitude in function to the exposure?
Yeah, so indeed, I mean, this question is related, I guess, to some of the previous questions. I mean, the best way is to let the data speak. And so our data clearly speaks and shows that exposure to COVID is unprecedented. Like all firms nearly at some stage talk about it, facing risks, uncertainties. Their sentiment varies, not just firm by firm, but also over time. And so the level of this and also the spread, say, across industries is something that we have not seen before. And not seen before, I'm referring to the previous epidemic diseases that that I list here. SARS, H1N1, MERS, Ebola, Zika, none of these. I mean, clearly the COVID exposure, risk and uncertainty, and also sentiment differs significantly from what we've seen in these prior pandemics. So I think the data here speaks for itself.
Okay, so I guess now it's your turn again to talk us a little bit through the interesting data that you have, and roughly, 15 minutes, whatever.
Sure.
I gotta interrupt you at some point when I feel that the questions get too overwhelming.
Definitely. Thanks a lot. Yeah. So talking about these measures, so let me quickly introduce you to them. This is the crudest, if you like. So this formula here says that every time that we come across a disease term, and I'm going to talk about how we obtain these words in a second. Every time we come across this word, it's going to be flagged as a 1. And so we take, for every transcript, we take the sum of disease words being mentioned in conference calls, and we subsequently divide this by the length of the transcript in terms of the total number of words found in the transcript of firm I in quarter T. So how do we identify these disease words? First of all, we went to the WHO website to identify and get a list of these epidemics or epidemic diseases, 2002 onwards. We decided to focus mainly, there are many out there. It's really scary if you take a look at that list. There are many out there. We decided to, for now, just focus on those that we deem to be of interest to investors. So we eliminate various outbreaks, for example, the monkeypox 2018 outbreaks, and decided to just focus on these in order of occurrence: SARS, swine flu, MERS, Ebola, Zika, and most recently COVID-19. Typically, like, various synonyms for every disease are being used, and so we identified these subsequently in the second step from various online resources and newspaper articles. And so that ended up in a synonym, a word list per disease. And after using, say, these word lists on our transcripts, we also did a human audit of transcript being flagged as mentioning these various diseases, just to verify that we actually are using the right disease words. And so something, of course, that we don't want to see like being flagged is something which is abbreviated as MERS, but is simply Malaysian Emergency Response, the telephone number 9099. And so we needed to clean for this. So here's in short, the word list that we use. You can also find this in the paper. So that's the exposure measure, say that the really high level measure. But then we dive deeper. And so here's the risk measure that also came up in one of the questions. So simply look for every time a disease word's been used in a transcript, then look up the 10 words before and after, and then verify whether in this range of 10 words before and after a risk or uncertainty synonym, which we take from the Oxford English Dictionary, is being used, again, in close vicinity to this disease word. Now, the thing is, for any risk-based, text-based risk measure that you use, is that innovations to the variance of shocks are also likely correlated with innovations to the conditional mean. What do I mean by this is that it's important not just to capture the uncertainty or risk component, and so the second moment, but it's also important to capture the first moment effects, the news effects, if you like. And so, for example, if you think about a company which has been told that its government is going to consider like a full lockdown, this company simultaneously also learns that it will face a lower mean because of potential collapse of demand because of the full lockdown. But at the same time, it also learns that it faces a higher variance. The impact and duration of this lockdown are uncertain. And so it's really important. That's a major challenge to a risk measure, And so therefore, we also develop and introduce the second measure, which we call disease sentiment. And so again, for every epidemic disease, again, in the close vicinity, that is 10 words before, 10 words after, we're going to verify whether a sentiment word. And so here's McDonald's, Loughran and McDonald's dictionary that we use, the sentiment dictionary. And every time there's a positive tone word, it's flagged as +1. If there's a negative tone word being used in close vicinity to a disease word, it's flagged as -1. Now, one thing that we learned from looking at our descriptive statistics is that these disease-related discussions tend to be heavily dominated by negative tone words. And so in some of the tests, we bifurcate this overall disease sentiment into two groups: disease negative sentiment and disease positive sentiment. Now, here's one of the questions was about, are we looking at we're looking at COVID here, and so is COVID really different from prior diseases? And so the clear answer is, and so you're looking at data here, which we updated until, say, April 30th. So until now, so the paper incorporates data which was updated until March 7, 2020. We have had like 2 rounds of updates of the data, harvesting new transcripts and updating our measures. And so the graphs that I'm presenting in this presentation here are based on data available up until April 30. And so what you can clearly see here is that in terms of impact, COVID outbeats any prior epidemic disease. The next closest competitor, if you like, is SARS. So what we present here on the y-axis is the percentage of conference calls, earnings conference calls, mentioning, in this case, COVID, in this case, SARS, and other diseases. Nowadays, like close to all firms are talking about it. In the previous version, so if you look at the paper, when we use data in conference calls held through March 7, so that's our initial sample, 40%. So this was like close to 40% of firms in conference calls discussing COVID outbreak. SARS, I mentioned, closest as 20%, just over 20%. We also break this down by geographical regions, like China, Europe, United States, and others. And so so you can see this graph, and you can find it in the paper. There too, we find some very interesting differences across epidemic diseases. Until now, so far, SARS has been like the more pervasive topic of discussion in conference calls held by Chinese headquarter firms, even more so than COVID. And so you find like various regional differences in terms of like exposure to epidemic diseases, which is really interesting. The other measures that we have here on top in the first panel is COVID risk. By the way, we multiply all our measures by 1,000 for readability purposes, and also in subsequent regression analysis. And so, as you can see here, we plot this over time. So it's increasing up till, say, like the first few weeks of April, and then it has like a short, sharp decline, and then it's climbing up again. So at this peak, so a 0.2 value here indicates that this is close to 0.02% of all words in a transcript on average are risk-related COVID terms. Right, that's the way to interpret this value up here. Down below, in the second panel below, we present the COVID sentiment, again multiplied by 1,000. So the minimum score here is negative. So the overall, as I said, the overall sentiment, COVID sentiment is really the negative. A negative score of 0.4 essentially means that 0.04% of words used in conference calls on average are negative sentiment COVID terms. So we can, do all kinds of analysis. So here we plotted by country. Again, this is data until April 30. So So what we see here is that China, is on top of the rank. Even if you look at, say, the paper where we use data updated until March 7th, the rank ordering of countries is not that different. So China has been and is still on top of things here. So the ordering is not that different. However, some firms move up and down the ranks a little bit. And it's interesting to note, for example, Italy in the March 7 data, in the graph, the bar graph that we present in the paper, it was ranked at 40%. 40% of transcripts for firms headquartered in Italy discussing COVID. It's gone up to 75% until recently. Other countries, for example, Norway, which is low down below here, also used to be low at the beginning of the outbreak. The US, important to, I guess, interesting to point out, is so from top to bottom ranked at a 24th position. It's going up, the percentage of transcripts by US headquartered firms is going up from 40% to 50%. Similar splits, and this is really interesting, I think, where we do a split by industry. And so again, this is data until April 30. And so it's headed by the manufacturing industry, closely followed by wholesale and retail trade. I guess the interesting and maybe anomaly in here is the finance, insurance, and real estate industry. So even though, say, 30% is, say, roughly the percentage of transcripts from these firms in these industries discussing COVID, so it's not, I'd say, it's not minor, but relative to the others industries, it's like a clear anomaly. And so one thing that we're definitely considering doing next is to try to understand this better. How come? Is this because these firms may have held fewer conference calls in this time period? And so that's lagging behind, or we just want to understand this a little bit better. So in the paper we do like case studies where we look at firms like individually to kind of track them over time and how they've been differently affected by various diseases. One thing we're definitely interested in doing next is to understand what's happening here in this particular industry, to better understand. Are these firms and is this industry less affected by COVID, or somehow, manages, less frequently talk about it, and it's not being mentioned and doesn't enter discussions by conference call participants as much. And so even there for this industry, if you look at the March 7 data, it's gone up from 25% to now just slightly over 30%. So even for this industry, finance, insurance, and real estate, we do observe some increase, but again, it's ranked at the bottom. Similarly, again by industry, but then plotted over, let's say, over time. So this is on a weekly basis. A couple of interesting things here. So the gray line here represents the mining and construction industry. This peaks at close to 20% halfway of April. And if you look at the other industries, you can kind of see a gradual increasing steady trend. We also do this analysis and break down by geographic areas, as I said before. So at first, at the onset of the outbreak, this was mainly dominated, as you can see, by firms headquartered in China. But as you can also see, this increase, this sharp increase, is gradually steadily, I wouldn't say declining, but it's reaching some kind of steady state. Interesting here is also to note the steadily increasing trend that US headquarter firms exhibit. And there's a spike towards the end of April for UK firms, UK headquarter firms that you can see over here. This is another graph that we present. Let me, can't see it actually because of, okay, so it's these are these other diseases. So this is SARS. So everything up until now has been COVID related. So next is SARS. Again, plotted over time, rest of the world, Europe, United States, United Kingdom, and SARS countries separately. So SARS countries includes China, Hong Kong, Singapore, Vietnam, and Canada. And so, one thing, pattern is quite much more whimsical than what we've seen in the previous slides regarding COVID. Interesting here is that Europe seems to be catching up later in relative to other countries that we see respond much stronger earlier. This is for the swine flu for the period March 1, 2009 to July 31, 2010. Rest of the world, Europe, United States, and United Kingdom. Again, a very whimsical pattern, ups and downs at different points in times and for different regions. The next thing that so going back to the COVID discussion in conference calls, so here we do a split on, say, like early and highest. And so firms with the highest COVID exposure, and B is with the highest COVID exposure, but in January. So this is like splitting on like how early, how quick, and the first is on extensiveness of COVID discussions. And so a couple of things that are interesting here is that fashion retail companies, Abercrombie and Fitch and Crocs, are listed highly and ranked highly here among the top 10 firms with highest COVID exposure. I have to acknowledge, though, to admit that this is based on data which we updated until March 7th. So this table might look, and I guess will look differently once we have updated it, incorporated the more recent data. Also, healthcare firms are among the top 10 firms listed in panel A. PPD, Agilent are among them. If you switch to panel B, the firms with the earliest and highest COVID exposure, that is in January, includes, not surprisingly perhaps, several airline companies. United is in there, American is in there. Maybe the surprising finding here is that Chinese firms, firms headquartered in China, are not among them. And this is just a simple like regulatory finding. By law, Chinese firms are required to have fiscal year ends in December, meaning it just takes some more time for these firms to host earnings-related conference calls and to show up in our sample. Okay, so maybe Joachim, this is a good time to take a few more questions, and then I'll dive into the content.
Stephan.
Okay,
perfect.
Good.
Thanks.
Same-minded.
First, Marcello, you have a question. I would like to move this question towards the end of the talk because I think this is a super interesting but somewhat more big picture question. If that's okay. Yeah. So Marcello, please hang on. Then I would like to move on to Francesco Groschetti. Francesco, floor is yours.
Yep. Can you hear me?
Of course we do.
Perfect.
All right. So that's a question that really comes out of curiosity. So I am actually working on the natural language processing methodologies and algorithms applied in accounting and finance. So I was just wondering why you guys didn't choose to go down some more sophisticated bar, but much more reliable and robust techniques like BERT or some other deep learning methodologies, which happens to be pretty amazing in detecting, which means classifying sentences or passages or documents, especially because you seems to have two tasks. One is being able to detect the risk exposure, and then eventually assigning a score in terms of sentiment. So the question is why you didn't choose to go there.
So is my connection poor? I didn't really get the question.
I also had problems hearing the last sentence, I think. But
okay, but I think I get the question. So essentially, they're like two tasks. Francesco indicated. So there's we try to capture risk, we try to capture sentiment, and so it sounded like Francesco's a little bit worried that maybe our approach is a little bit, too simplistic, and so there are much more advanced technologies out there and techniques. So I'm just going to continue talking. I think I still can't hear it, but I think that's kind of what I got from Francesco. Yeah, I mean, so the task, so it's essentially like flagging whether or not there's talk about COVID is not that complicated. And so in my mind, it doesn't require any more like complicated technologies. I mean, just for the one simple reason is that we have clear identifiers. So unlike, for example, in our political paper, so whereas, you know, we as human beings, the moment I drop the term, you know, politics, we all have associations with it, right? I don't have to explain like in detail, what do I mean by politics, right? We immediately have associations like, but if I then want to use a machine to actually codify, you know, talk about politics, I mean, that takes quite some, you know, some time and effort to actually train a machine. And so there we need machine learning. However, here with COVID and prior epidemic diseases, we have these nice, unique words. COVID-19, COVID has been used before, but COVID-19, for example, has not. So these are unique unigrams or sometimes bigrams, like two-word combinations, which are like not being used before. So meaning we can, you know, reliably use these to reliably capture, talk about, in this case, COVID. So we don't need this complicated machinery, at least to flag, talk about COVID. When it comes to risk and uncertainty, I guess there I'm with you. I mean, so there are alternative techniques out there. However, I mean, so we did like extensive human audits on the transcripts, which we flagged as risk-related or sentiment-related. And also in terms of like type 1, type 2 errors, like false positive and negatives. And the results come out really, really strong. And so even though we acknowledge that there are alternative methods out there, we don't think at this stage, and given the unique nature of the diseases, the shocks that we're looking at, it actually requires much like more heavy machinery.
Okay.
So Francesco is gone, but I hope he can hear my answer.
I think he could hear it, I hope so. Otherwise, he can still use the chat. So, Marco Trombetta, you would be next. I think you're still muted, Marco.
Hi there?
Yeah.
Okay. I can hear you, Marco.
Hi, Stephan. I'm a little bit concerned about comparing the previous crisis with COVID-19 crisis. I mean, you obviously shows us that this is something unprecedented. So it seems like we are running a stock market study, comparing the New York Stock Exchange with the Iranian stock market. Okay, it's obvious that this is something unprecedented. Okay, never before one of the previous crises created a situation where more than a third of the world was locked down in their home for the first time in history. Okay, so I really don't see how comparable the previous crises are to this one. And so this is my first. And secondly, related to what you have just presented, aren't we running this analysis too early? Okay, the other crisis, we have the pre, the peak, and the post. We are still in the middle of the crisis. So again, I cannot really compare what you observe for COVID-19 with what we observe for Ebola or Zika or SARS. It's just, we all want to know more about this, but maybe it's a little bit too early to draw a conclusion of this kind at this point.
Yeah, so a simple answer, a simple reply here is that, you know, we were stuck into our houses, we were locked in. So, and then we were hit by this crisis. And so we felt like we wanted to contribute. And so as among the co-authors, we said, you know, we felt like forced to actually sit down and use our machinery to come up with these measures. I hear what you're saying. And so we're not arguing that firms should learn from prior crises. This is something that the data tells us. If we look into the transcripts, and so for example, in one of the case studies that we do on United Airlines, management themselves tells us, and in response to questions and discussions that came up in a conference call, that they themselves claim that they learned from prior experiences. So this is not something that we are, argue or put forward as researchers. This is something that we document, that we see quite a number of times popping up in discussions, in conference calls. Managers indicating that, okay, we've gone through these, we experienced that we were very vulnerable in terms of relying on too few supply chains, parties. And so we learned, for example, from SARS that we needed to change that and to more diversify this. And so this is not something that we as researchers put forward. This is what managers themselves tell us. Now, whether this is too early or not, I mean, one thing that we could have done, of course, we could have looked at, say, the run-up of the SARS crisis and made a comparison between that and COVID nowadays. You know, the thing is, we're going to keep on harvesting further transcripts. We're going to keep monitoring and keep updating our measures as we go, make the data available. And, you know, I guess you know, ultimately, the data is going to tell whether we have been, you know, investigating this too early or too late. You know, we're just trying to, you know, we turned on the, you know, we started recording, if you like, you know, in a very like old technique term. We started to record all this data in order to, and generating these measures in order to understand. And I guess we can wait. I guess, but the risk of waiting and not conducting this type of analysis is that our data, our results show there's quite some variation into how firms are being affected. And so a one uniform, like a one-size-fits-all approach, that's kind of what our analysis to us suggests is may not be the right way thing to do. And so instead of, you know, not conducting this research and not informing, trying to inform and have data you know, based policy changes and measures, we felt like we had to contribute. I hope that kind of answers your questions. And so we're going to keep on monitoring the things and keep on updating the data. And hopefully this goes by anytime soon.
Okay, then we have a question by Mark Piokowski.
Hi, Stephan. Thank you very much. And thank you for making the data publicly available. It's really helpful. Related to some other points, I'm just curious if you think, especially in the US setting, there might be a current downward bias in your measure of disease exposure, in terms of the SEC was allowing firms up to a 45-day delay in their quarterly filings, and at least anecdotally, some firms are taking advantage of that. So the expectation I would have is that those firms that are delaying are the ones that are significantly impacted by the COVID and therefore not included in your sample currently.
Yeah, so these firms did hold conference calls. And so if they do hold conference calls, they're in our sample. And if market participants, analysts in particular, felt like they needed to ask questions about it, so if management felt like they didn't need to like spoon feed market participants themselves by mentioning and talk about COVID in their presentation section, like the floor was open for market participants, analysts to ask questions about it. And so given the uncertainty, my hunch is that they will have asked questions about this in the conference call. So I don't expect, and I guess that's one of the interesting things about features of conference calls is that there is this room for asking these types of questions. I mean, one thing that could happen is that so when analysts enter the conference call and enter the question queue, like indicating I have a COVID-related question, one thing that could happen is that management decided not to take these questions. But we don't have any evidence that is happening. So it's like really a voluntary measure. And yes, we're aware of this 45-day delay option, but we don't think this is going to bias U.S. firms, given that firms that were scheduled to host these conference calls also, did hold these conference calls and they're in our sample.
Great, thank you.
Thank you, Mark.
Okay, so we have another question lined up, but I would also like to postpone this to the final round of questions, if this is okay with you, Muna. Then if I look correctly, then you would have roughly another 15 minutes maybe to focus on some relevant findings that you want to showcase, and then we have another 5 minutes for the last round of quick questions. Okay.
Perfect. Okay, so let me deep dive then into content analysis, because I mean, one thing, knowing that whether a firm is exposed to COVID is and maybe an interesting question then is like how does the disease, like in more detail, impact firms' policies and performance? And so so again, here at this stage, we're focusing only for now, for the time being, on COVID-19. The main reason why we only focus on COVID-19 is because this requires human reading. At this stage, in the background, we are trying to automate this procedure with great success. And so we hope to come out with automated like scorings, content analysis anytime soon now. But what I'm going to present next is based on human reading. And so we identify all transcripts which at least have one mention of the COVID word. We identify snippets, so the 10 plus 10 minus 10 words around the COVID word. And there are quite a number of them, obviously. And from this, we drew a random sample of 367 transcripts. So we read them in full, the snippets for these transcripts. And we spread them across the various months, the first quarter, and also starting from April, the second quarter. And so we read them in detail and try to classify them according to the following, into the following buckets. So we predefined various issues based upon, reading supply chain disruption as a potential concern, drop in demand, employee welfare or labor market related concerns, production capacity reduction, but also retail store closures. Fifth category, which we classified, is increased uncertainty. And the sixth, the sort of negative sort of concerns, is financial market or financing concerns. At the same time, also firms, some managers indicate that we're not being impacted. At least they expect not to be impacted. So that's a separate seventh category. And the last category is where it's more like a positive, an opportunity, where managers indicate that they actually expect that COVID created some opportunities for the firm. So these are the quote unquote winners. And approximately 13% of the transcripts, the coronavirus is being mentioned by managers in a snippet, but we're just not able to specify exactly what the concern is or the opportunity. And so let me give you an example of this. This is from Fluence Corporate, 2nd of February 2020. All of us around the world follow the dynamic situation regarding the outbreak of the coronavirus. So here's the mentioning in China, and we are monitoring any impact it may have on our business. So this is an example of what we call an unspecified snippet. We just can't fit it in one of these previous aforementioned buckets. And so here are the results where we tabulate based on the human reading the concerns, and listed based on the rank order. It's dominated the discussion, COVID-related discussion on the potential negative demand shocks that firms expect. So it's mentioned in close to 45%. So next here we have some excerpts, some examples. The waterborne coatings tied especially to container shipping containers is still off because of the trade war. Now, because the coronavirus is exacerbating that situation, so demand is relatively soft in China, and so on and so forth. The next is on the list is increased uncertainties, roughly 39% of the time. Supply chain comes next, 26% of the time. Production capacity problems, concerns about employee welfare, labor markets. Surprisingly here is that the financial market and financing concerns comes like latest. And that's, so this is like overall during these 4 months, January until April. In the next table, we also indicate and do the analysis month by month, as I mentioned. Before actually going to take a look at that table, I want to mention that close to 11% of the transcripts indicate that they don't expect any impact. A very little amount that has happening in Asia in January. We didn't see any impact to our business because of the coronavirus. And some firms, as I indicated, also expect some opportunities. Here, close to 13%. I think there's ways to look at this. First is the Chinese people, as a result of this kind of coronavirus, they might actually heighten or elevate the trust to reliability to Japan or the Japanese products, so including that. So here's clearly like a brand, a reputation benefit that this particular company, Shiseido company, is expecting. Now, as I said, we also did this analysis, and we can split it by period, and then several interesting findings pop up. So this is the change in frequency for these various classes. Supply chain, interesting, listed here third, is tripling nearly from January going up to February. And then afterwards, so onwards, March, then it starts to abate. There's also a market increase for financing concerns. As I pointed out, it was relatively low. It was like ranked lowest in the overall table in the preceding slide. But over time, it shows like really interesting results here. That in January was like only like 1%, close to 1%. But then this has gone up to close to 36% most recently in April. And most of the concerns, finance concerns, relate to liquidity, but also credit access. And also interesting, market opportunities tend to be on the rise. As you can see, going up from close to 7% to nearly 22% in April. Now, to show to demonstrate the working of our exposure measure, I mentioned this. We also conduct some case studies. So we look into like specific firms in detail. Now, Marco had a question about, you know, U.S. stock exchange and some maybe Iranian stock exchange. So we're not doing that type of analysis. We're actually keeping everything constant here. And so we're looking at one firm, and then over time, whether this firm has been exposed to prior epidemic diseases, yes or no, and how does this show, for example, here for United Airlines. And as you can see here, for United Airlines, it has had significant exposure to various previous epidemic diseases. So here in the boxes, we include some excerpts taken from actual conference calls. And so they mentioned they've been impacted by SARS. Apparently the New York, Hong Kong route had been canceled through June 1st in 2003. H1 is they've been exposed to the swine flu. Here's an interesting observation. The safety impact of the coronavirus, of course, are foremost concern. At this point, public health agencies are not recommending any travel. So this is really early stage. This is the fourth quarter 2019 conference call held in the first weeks of 2020. Interesting observation here is too, this excerpt that we see here, where United's management is saying, I wonder what network contingency might be thinking about. It is similar to H1N1 years ago. We actually have good flexibility in order to adjust our capacity. And so here's another example of management kind of displaying, showing that we have learned, they have learned and have from prior experiencing an epidemic disease. The other example here that we present is from Abercrombie & Fitch, the casual wear retailer. Clearly, I mean, in comparison to United, Abercrombie was less affected by prior epidemic diseases. I mean, it was definitely hit largely, strongly by the coronavirus. And this really shows to us how unique the COVID crisis and outbreak is relative to prior epidemic diseases, in this case, particular to Abercrombie, which has had little exposure to prior diseases. Now, then we come to sorry, with a few more minutes, we essentially like ask two questions, research questions in the paper after introducing these measures. And the first is, do firms, and so as we get these expectations regarding their first movements exposures to epidemic diseases, does that vary predictably in the cross-section? And so here we're trying to capture kind of this resilience idea, whether firms actually learned or from prior epidemic, having experienced prior epidemic diseases. And so our variable of interest here is prior epidemic. And so it's scaled by the length of the transcripts, the total times SARS or the swine flu, H1N1 synonyms are being used in conference calls held in 2003. So that's when the SARS outbreak happened, or in 2009, the swine flu outbreak. And so it's the total sum of these two disease synonyms scaled by the number of words per transcript. We include various control variables, firm size, stock return beta, as I said, headquarters country, fixed effects in all the analysis, but also industry fixed effects. And in this analysis, we drop firms from the healthcare and pharmaceutical industries because, I mean, their exposure and circumstances during such a public health crisis are very much different from many other firms that we have in our sample. All right. And so here are some descriptive statistics. So in a matter of time, in the interest of time, I'm going to skip over this. It's in the paper. And so here's this main result. So in the first column, so we study the link between COVID exposure, our variable of interest, and the dependent variable is COVID negative sentiment. No, so why do we use COVID negative sentiment? And as I said, the overall tone is predominantly negative. And so this in the first column, this first coefficient shows that each mention of COVID in a transcript is accompanied by a 0.280 negative tone words, again related to COVID. Now in column 2, we are turning to the main question, and so whether a prior experience is actually associated with a negative sentiment, a less negative sentiment. And so this coefficient here, statistically significant at a 5% level, to give like an economic meaning to this in terms of magnitude, like a 1 standard deviation increase in prior epidemic experience is associated with a 2.3% decrease in negative tone words. So meaning these managers tend to be more like hopeful, optimistic, more positive about the impact that COVID will have on their business, on their performance. And so we ran this analysis both for the full sample, including all countries around there, and also for subsequently, separately for the US sample. Similar results. Then to move on, so we also repeated this for our other measures. Interestingly, we only find this link with COVID risk, but not with our alternative measure. So COVID exposure and prior epidemic experience is significantly correlated positively for the full sample in the US, but COVID risk is, this relationship, this association is not significant for both samples. Then let's move on to, given in the interest of time, to the second question that we ask in a paper, whether these measures, and in particular COVID sentiment and COVID risk, are priced by the stock market. So this is a specification that we use. So on the left-hand side, we have return, cumulative return measured either using a short window, that's the 3-day window around the earnings call date, or a longer window, the quarter-to-date cumulative return, which starts on January 1st and ends on March 15, 2020. We expect, based on standard asset pricing models, that investors will revise beliefs regarding either the numerator, the expected future cash flows, or a denominator effect, expected discount rate revision of beliefs, and that's going to affect the change in prices on aggregate. So we expect a more positive sentiment regarding an epidemic disease should be associated with an increase in stock returns measured in the short window and in the longer window. And similarly, having perceived a higher epidemic risk is expected to be negative associated with the same. So here are the results, presenting the short window results. As you can see, all the variables have the correct sign. So more extensive discussion on COVID. Firms exhibit a greater decline in stock prices. That's what this first column here points out. Economically, a 1 standard deviation increase and then COVID exposure is associated with a 1.16 percent point lower return. In the second column, we test the effect of negative and positive sentiment on stock returns separately. So we're asking the question whether this return response, whether that derives from investors' revising their expectations regarding future cash flows. And so we're using sentiment as a proxy for that type of revision. And in the third column, we tackle the question whether maybe this is driven, the response that we observe, by revisions in their estimates or expectations regarding the required rate of return, so the denominator effect, for which we use COVID-19 risk as an approximation. And as you can see, like separately in separate specifications, column 2 and 3, both load significantly with the correct sign. Then in the fourth column, again, for the full sample, we ran a horse race to see which of the two dominates. And as you can see, the coefficient on COVID risk turns insignificant. So it's clearly dominated by revisions in cash flow expectations rather than changes in beliefs about risks. Similar results, by the way, document for the US sample. And here are the long window results. Notice that I have 5 more minutes, so I'm going to wrap up very quickly. Similar findings. However, interestingly, the moment we now run this horse race with this longer window, so quarter to date stock returns, cumulative stock returns, we find both sentiment and risk to still load. For the US sample, the COVID negative sentiment coefficient turns insignificant, however, and the COVID risk seems to dominate the market response, the long window market response. To wrap up, so essentially this is just a wrap up of the findings. A new measure, exposure to these various diseases. We've conducted like content analysis. We managed to identify exactly the individual, the concerns and also opportunities that managers face. And we also find some evidence in terms of resilience that having previously experienced an epidemic disease maps into expectations and making them more positive about how, about their ability, how firms are expecting to deal with the coronavirus outbreak.
Okay.
Thank you.
Thank you, Stephan. So we have a little bit of time left for a quick round of last questions. And I'm not sure whether I get to everybody, but I definitely go to Marcelo because I postponed his question from an earlier session. So Marcelo, you have a question about the situation in Brazil, I assume.
Marcelo?
Hold on, he's still unmuted. Okay. Marcelo, can we unmute Marcelo?
So you have his question?
Yes, I can read out the question otherwise, but let me, yeah. So Marcelo, sorry, I'm gonna read out your question. He says he's a resident of one of the cities most affected by COVID-19 in Brazil, Recife. Considering the comments of the Minister of Economy in Brazil published by the press, what to expect from the near future with the effects of COVID-19, despite the experiences most positive aspects of companies with SARS and H1N1 epidemics? I think it's related to whether you can say anything about Brazil, where we have Brazilian firms in your sample and about the situation in Brazil, which we know is getting worse as we speak.
Right. Yeah. So I saw the news also like a few hours ago. So the numbers of infections indeed is rising sharply day by day in Brazil. Yeah, that's an excellent question. So the question I think is related to you know, the type of effects that we document in this paper and whether we can actually make some predictions what's going to happen for these Brazilian firms, and in particular these firms that have previously experienced an epidemic disease. You know, I would be. So I think this is a very tough question to take and to answer. Very interesting. I'm kind of reluctant, however, to kind of make specific predictions what's going to happen for like individual firms. So what we do document is on average, and so this is after controlling for firm fixed effects, as I indicated in our specifications. So it's kind of completely washing out any like country fixed effects. I would be very interested in looking like more in depth into so we have relatively few Brazilian firm observations in our sample. What's happening to them? So I will have to get back out to Marcelo, I guess, like in private on this.
One thing also, because sorry for pressing here, maybe one hint for Marcelo also, since you are making the data publicly available, would it be an option for him maybe also to take a look at some point himself for the Brazilian using Brazilian data? Yeah, could it?
I mean, that's like one of the nice features of having these virtual seminars, that I can actually redirect a question to a participant. That would be awesome. So Marcelo, please reach out to us and use our data. And I mean, you have much more institutional knowledge and about these firms and you know, the country in itself, and also in terms of like time, measures taken, and so on and so forth. So please come back to us indeed and inform us about your thoughts about this.
Okay, I think this is a nice way to wrap this up. We have some questions which have to remain on the table, unfortunately, related also to the reliability of your coding approach and what you've done about it. I would have loved to talk about the interconnectedness of political measures and what companies say about it. So I think this is something that would be interesting going forward. But we can leave all this to the chatter, maybe also at the virtual reception, because what would be a European conference or a European seminar without a reception? So I hand over to Gio. She will talk us to the next steps, meaning the next seminar and the upcoming reception. Gio, floor is yours.
Thank you very much.
Yeah, so I wanted to ask a very quick question, and maybe this is also something that participants might appreciate. So all the questions and suggestions that have been raised in the chat box, will they become available afterwards?
I do hope so.
Okay, that would be awesome. That means I will have access to all questions.
Works. It seems to be complicated with Zoom, but we will do our very best.
Okay, thank you.
I will take photos.
Okay, thank you.
Sorry, Gio.
Yeah, great. Thank you. Thank you, Stephen, for your presentation, and to Joachim for moderating the first virtual accounting research seminar so well. Also, thank you for everybody for joining us today. I think it went very well. We hope you will join us again next week. We have Carlos Larinaga from the University of Burgos. You will be able to register again for the seminar on the VARS website starting at 6 p.m. This afternoon. For those of you who have registered for the virtual reception, you need to leave this meeting and join us in the other room. We will start it very shortly. Just thank you again, everyone, and hopefully we'll see you next week.
Okay, so everybody.
Thanks, everyone.
Bye.
We give a round of virtual applause, I'd say.
Yes. Thanks, Stephan.
Thank you, guys.
Everybody.
Thank you.
Reception. If you're around, if you're not around, register next time for the reception. Yeah, it will be fun. Okay.
Bye. Okay, guys, I'm gonna go so I can open. No, Joachim must go, I guess.
Yeah, I have to leave, I think. I'm gonna leave and then everybody has to leave, I fear.
Yeah, that's the thing.
Oh, yeah, you're also host. You can stay. I'm gonna open.
Okay, okay. Leave me as a host.
Bye,
Bye.
everybody.
Bye, everyone.
It's been a pleasure. It has been a blast.